a snowy run today. Wait, was it after your run?
It was on the way down the mountainside.
Oh.
It was starting to snow.
But once you finished,
it was snowing.
That's when it was
It was snowing, but it was snowing, but not like thick snow. Yeah, it was a little bit lighter snow.
Yeah, welcome to Utah.
Hey, no, right? Nothing, and then boom.
Yeah, I didn't even know it was gonna snow. It's like that old. It was a trend for a minute. And nothing can go wrong. Oh no!
I haven't seen that one.
Oh, it's funny. I'll show you after.
Okay, deal.
It's pretty good. What's up, everybody? This is the HIG podcast. I am MattyP here with your host of this podcast, Bronson Kaufusi, the one and the only. The reason why my kids want to listen, actually. My youngest, Xander, he's pretty funny. He's like, where's the other guy? Like what? And then your voice will come on. He's like, yeah, Bronson.
That's
like,
so funny.
I call Bronson on my team.
He said my team.
They have this thing where they call like cars that they like on their team.
Oh,
like
yeah.
A tractor.
Oh, yeah,
or
yeah.
Something. Like, I call that Cybertruck on my team. And then they'll fight about it for a few minutes.
You call anything on your team, too.
I know. Yeah, it's great. Tractors, Cybertrucks, Bronson. So your team's Xander.
I'm signed up.
All right. How was your Christmas?
It was great. Yeah, hung out with the fam. Santa came. Ate so much food, honestly. I was so full all day.
Nice.
Yeah, so it was good.
That's good.
Fun to hang out with the family. So, how about you?
It was wild and didn't get much sleep the night before, so I was really tired. It's one of those days that it feels like it lasts for a week, but then you realize that it's like 4 p.m.
Yeah.
And it's like, where did the day go? So you're really tired, but you're also kind of delirious. That's my Christmas.
Yeah, that's true.
So, and Jen and I, we have the 2 Christmases, right? Because we're a mixed family.
Mm-hmm.
So Christmas 2.0 is coming up.
Let's go.
In a couple of days.
Let's go.
And speaking of 2.0, that is what we are here today to introduce. Part 2 of this tax strategy from Jason Harris. So
good.
Lots of good stuff. We kind of left it on a cliffhanger before. Getting right into the
rep status.
So cliffhanger, and in comes part 2.
Oh, the rep status is so valuable to people. I think, and what's interesting is like a lot of people don't know about it. As I go around and meet with people, a lot of people don't know about it, and when they learn about it, they get really excited. It's one way that you can accelerate your wealth strategy, especially if you own real estate. It's so powerful.
And that's where we left off. That's where
It's
Jason kicks this one off.
It's going to be good.
Right? So rep status, retirement, tax-free growth, velocity of money, a bunch of other cool stuff.
It's actually, what he's about to talk about is like the game changer. It's like the pinnacle of his presentation.
It's his favorite thing to talk about.
Yeah, because it helped him so much, honestly.
Yeah, and it's been able to help so many other people.
Yeah.
It's valuable information. One last thing before we dive into this. It's important for us to say that we are not providing tax, legal, or accounting advice. This episode of the HIG podcast has been prepared for informational and educational purposes only. If you have any questions about this, check out the homepage of the HIG podcast on this specific episode. We have our complete disclaimer in our notes.
Yeah.
So, there you have it. Without making you wait anymore, here is part 2.
So I want to supersize this, and this is, if you learn anything tonight, this is the best part that you want to pay attention to. Let's talk about how we can use it in a more favorable way. And that's when it comes to something called REPS status, Real Estate Professional Designation, REPS. The only reason this loss, the main reason is because the loss is passive in nature. So the loss, the depreciation, comes through to you as a passive loss, so it only shelters passive income. However, what if you could reclassify the loss as an active loss? Active losses can shelter active income. Active losses are the best losses because they can shelter all forms of income. That includes W-2 wages. It includes capital gains. Let's say you're selling your practice because you're a dentist and you've worked hard for 35 years and you're now retiring, and you sell your practice for $5 million. You can use this $16.5 million write-off and offset your $5 million capital gain and not pay a dime in tax. Some of you may have invested in crypto when it was good. A lot of you probably invested when it was bad. I'm kidding. But there are a lot of people I've talked to lost a lot in crypto. It's very speculative, right? However, there are people who've done very, very well. And maybe you have massive gains. You could take those gains, sell them. That now is a capital gains tax. Take those profits and invest in a truck stop. And then the losses generated from the truck stop, if you're able to classify that loss as active, use that loss to offset the gain of your crypto, the gain of your real estate, the gain of your business. We helped in 2021 a solar company sell their company for $60 million, and they took a portion of those profits and bought a bunch of gas stations and didn't pay a dime in tax on the sale of their $60 million company. That was a mind-blowing thing for them and has been life-changing, being able to keep more of their hard-earned money because the IRS gave them meaningful tax deductions for solving energy and real estate problems that the government has. But as a part of that, one of the funniest discussions that we had to overcome with our lenders we're just not understanding why are solar renewable energy guys investing in oil. It doesn't make any sense to us. Anyhow, that was a fun discussion that we had to explain. We got over it. We closed. It ended up being a great tax deduction and tax benefit for them. What I'm trying to say is, if you can use these non-cash expense deductions to help shelter your day job income, imagine if whatever you're making today, you didn't have to pay $1 in taxes. And you could keep that money. And you keep it and you put it to work buying assets that the government wants you to buy. They're incentivizing you to buy. They're asking you to buy. And if you're willing to do so, you can get wealthy in the process, and they'll give you tax benefits for doing so. That is the game. And this is one of the best tax strategies available in the tax code. And I know a lot of them. And I mean that because I talk to a lot of affluent people, a lot of successful people. And I've seen the tax strategies that work and the ones that don't work, and the ones that are speculative and are probably gray and even red. I don't know what you call it. What's worse than gray? Ones that you likely, if you're audited, you're in trouble, right? This is not an aggressive tax strategy. Why? Because it's not a loophole. This is not an unintended consequence. Meaning there are certain times that there's code added, tax law, and then there's a byproduct loophole way around it that can help someone still generate the desired result. This is intended. The code is in there specifically for this benefit. They want you to do it because it was written out for it. It's tax law. So if you are audited, and I've been audited, I won. In that audit, I actually amended in my favor and I got more money back on my tax return. 2017, 2019, and 2020, after a year, I finally won and I had to amend in 1 year. That one I actually got the money back. 2017's I'm still working on. But what I'm trying to say is, I wasn't concerned. I wasn't nervous. I knew the tax law, and I helped show them here in the tax law, this is what I'm doing, and this is why I'm doing it. And so I want you to know this isn't something that I'm sharing with you that you need to be concerned with. Tom Wheelwright, Tax-Free Wealth, the Win-Win Wealth Strategy, go read it. He has several chapters dedicated to just talk about this is the best tax deduction in the tax code. He calls it the king. It's the king of all tax deductions. If you want to do it right and you want to do it best, use depreciation, bonus depreciation. Truck stops are very unique. They have the best tax write-offs. Not all real estate is created equal. Meaning This commercial office building doesn't have anywhere near as good of a tax loss write-off bonus as what I could get in a truck stop. Car washes are pretty good. Multifamily's better than office and industrial and retail, but it's not anywhere near what truck stops are. We like truck stops as a real estate investment, but we love them further because of the tax benefits that they provide to us and to our investor partners. Any questions on that before I keep going?
You mentioned opportunity zones earlier. I don't know if you're going to get into it. If they're done right, it's pretty sweet.
Supercharging it. Yes. In fact, we're very hopeful the Trump administration will bring back OZ funds because right now it's almost on the tail end. It's no longer that favorable. However, if OZ funds do come back, what's interesting is with truck stops, they're often located in OZ areas that have been approved. So then you can set up an OZ fund, invest through the fund that purchases the truck stop. Then you get the bonus depreciation loss write-off and the capital gains benefit. Absolutely.
Also, just a quick question on the rep status. I know, you become a real estate agent, you get licensed, but there's another strategy where, it's hard to do because you're usually a limited partner coming into these things.
Correct.
But if you can be classified as a general partner, then you get that same.
Without the hours needed, absolutely. Or we allow in our funds TIC investments, direct investments into it, which just shows a little bit more involvement for material participation purposes. But then another way that you can help with that is what's called the grouping election. You may spend a lot of hours by managing a fourplex that you've purchased, but you also own some other real estate. This grouping election allows you to get more material participation and hours if you spend more of your time on the fourplex, but still get the depreciation on all the real estate you own, even if some of them are completely passive in nature and this one you're active in. All of your real estate in that group is considered active, allowing all the depreciation pass-through to come as an active loss. It's treated as a group. I just didn't want to get into too much of the nitty-gritty, but no, Brian comes with 40 years of experience in the tax code, so he's checking on me, making sure I do a good job tonight. So how am I doing so far, Brian? Okay, good. I think I touched on a lot of these different ways that you can utilize rep status. I have another section I'll get to talk about some other cool use cases, but I just want to point out one more time. NOL carryover, that may mean nothing to you, but it stands for net operating loss carry forward. If you generated this massive loss, but you didn't have enough income to use it today in 2024, you get to carry over that loss to next year. Why I find this so important and something I want to emphasize is every year I carry forward losses. Last year, my 2023 to 2024, I carried forward a $5.2 million loss. The reason why I'm pointing that out is that means this year I can make $5.2 million of income and know I already have a deduction lined up to cover it. I can make $5.2 million and I already have a loss that can shelter it. That helps me navigate my investment strategy. I still want to carry over more losses, but I don't necessarily need to invest to generate a loss. I can invest in other assets that I want to diversify in, that I want to grow wealth in, and so I max out my retirement accounts. I do all things Roth. What's the game? What's the objective of the game that we've talked about? Grow wealth and do it with permanent taxes. So why would I invest then in a Roth? What happens in a Roth retirement account? Isley, you better know this. Tax-free growth, right? And at 59.5, it's permanent. Once you're at 59.5, all your money that you grew in a Roth account becomes a permanent tax-free account. So I maximize as much as I can do in a Roth account every year. Roth 401k, Roth IRA, and my wife and I both do it, and we take full advantage of it every single year. That now is growing a pillar of wealth tax-free. I have my real estate that's very tax efficient as well, that I have lots of depreciation loss, sheltering all of the income that I'm making from it. But in addition to that, I'm utilizing some of the other strategies like 1031 exchanges. So now I'm not paying taxes on the gains. When I sell it, I can repurpose it to something new that continues to grow my wealth tax efficiently without having to pay taxes. So the rules of operations is you take the match first. So you do whatever's necessary in your 401k to get the match. Then you go to your Roth IRA. And then if you have more, you come back to your 401k and fully max it out. In my case, I max out all of it, so I still get my match. So of course you get the match, and that's always the first one. But do a Roth 401k, not traditional 401k contributions, if you can. And that's more what I'm trying to emphasize. All things Roth. Roth 401k, Roth IRA. And if your company has a match, at Harris Investment Group, we have a match. That match will come if you make your own contribution to your plan. That portion, however, will grow tax deferred, not tax free. But since you brought it up, Brian, I think it's important to add, if you ever retire or quit and go to a new job, you get to roll those funds, if you choose to, into a Roth or traditional IRA. That's where then any traditional portion you could convert. You can convert 401k and IRA monies to Roth. Now, in doing so, that creates a taxable event. Well, guess what? What are you going to use to shelter that taxable event? Depreciation. Use your depreciation and convert all of it and make sure you are growing all of your wealth tax-free. That's the game. And we know the rules. I'm teaching you a couple of them. Utilize it. If you're in a position to take active status, that status will allow you to convert all tax-deferred money to tax-free money, and do it as soon as you can. Because the longer you wait, the more hopefully your account values are growing, but that's more taxable dollars that you have to pay taxes on and convert, or more losses that you have to generate to do that conversion. Does that make sense? I helped someone, in this case, we talked about that $3 million account. It was all traditional. They were 5 years out from retirement. They bought real estate, they took active status, they converted all $3 million to Roth 401k dollars. And when they retired, they had $3 million of tax-free money and tax-free cash flow from their real estate. And beyond that, tax-free Social Security income. It blows my mind that Social Security is taxable. When you're taxed going in, you're taxed coming out. It's the only legal Ponzi scheme that we know of. My point is, current tax policy is, if you make a certain amount of taxable income each year, you have to pay taxes on your Social Security income. So that's supposed to be and intended to be for those that make more money or are more wealthy. But what if all of your wealth was tax-free? You could have $20 million of Roth IRA and Roth 401k money. And all $20 million, if it was paid out to you, how much taxable income do you report that year? Zero. So what if you had $100 million of Roth money? It's still zero. If you have tax-free money and you can pay that to yourself, you still have zero taxable income. And what if you had $100 million worth of real estate and you had depreciation that was offsetting all the cash flow that you were making from the real estate? How much taxable income do you have? Zero. So how much taxable income do you report justifies then how much taxes you pay on Social Security income. So there's something called Getting to Zero. I think that's the name of the book. Getting to Zero. And it talks about getting your wealth, the object of the game, growing your wealth and doing it with permanent tax benefits. Because if you do, now all Social Security income benefits are paid out to you tax-free. Now you have multiple buckets of income paying to you tax-free. So thanks for bringing that up, Brian. When you self-direct, you can invest in assets beyond traditional asset classes. I've done hard money loans out of my self-directed Roth. I own commercial buildings in my self-directed Roth. You can flip Taylor Swift tickets if you want to in your self-directed Roth. I know people who've flipped jazz tickets, Utah Jazz tickets, and they do it in their Roth accounts. There are so many cool things that you can do with self-directed. We have self-directed investors that invest in our funds. And something kind of cool about this, Mike, that we're doing in our next year's fund, you can have different share classes. Because self-directed investors can't take the tax benefit of truck stops. Okay, we've talked about this.
No,
I want everyone else to hear it. Because retirement funds are growing tax deferred, or in Roths, tax free, there's no pass-through depreciation that they can take. Well, what if you could offer your depreciation for your pro rata equity that you own in that fund to someone who could take it? Now they get an outsized amount of depreciation, and in exchange, they could give you some economic benefit, more cash flow from theirs, or maybe growth on the back end. So we're offering share classes that allows for self-directed retirement funds to get more economic benefit for them to give up depreciation to someone else. And so we'll have share classes available that will allow for that type of treatment. So this is what we've already been talking about, but converting your traditional 401k and IRA to Roth without paying taxes. You can do that if you're considered active in your real estate. Because you're active in it, the loss is treated as active loss. And because it's an active loss, it can shelter all forms of income, including converting your retirement accounts to Roth. That allows for tax-free growth, which is permanent tax benefits. Again, the name of the game, grow your wealth and do it forever tax-free. It allows for tax-free withdrawals in retirement, or if you don't touch it, you can gift it. There have been rules that have changed recently on that, but that used to be allow for a child's lifetime. So the best strategy was gift all of your assets, if it's important to you in a legacy planning, to your kids, but your retirement accounts to your grandkids or even your great-grandkids. Why? Because if you give it to your great-grandkids, it can grow for 80 years tax-free in those accounts. A $10,000 amount would be tens of millions of dollars over 80 years if invested wisely. That's why you give the retirement accounts to the youngest in your line and your other wealth to your kids. Anyhow, phenomenal tax strategies and estate planning that I can't get into right now. There's no required minimum distributions on Roth accounts. On traditional accounts there are, because the IRS wants to tax you on it. And every year you get older, the percentage of what you have to pull out gets higher. Do you think tax rates are going up or down in the future? Anyone that thinks it's going lower probably hasn't seen what our national deficit is. It's more likely to go up than to go down. So why wait to convert your money later when tax rates are higher? If you can do it today, do it. Especially any of you who are younger. The younger you are, the longer you have. The time is on your side. That allows for more compounding and more wealth creation. Lastly, self-directed funds. We've talked some about that. Self-direct is the best. There's a lot of great creative ways, and there's outsized returns that you can make. And because it's a permanent, or because it's a tax-free account, you want your highest performing asset opportunities to be invested there. Had you invested in Bitcoin 8 years ago in your Roth, all of the growth would have happened tax-free, right? Instead of it being a taxable gain that you may have to sell, and then you have to get creative using a truck stop, which we'd be happy to help you do if you want. 1031 exchanges, I think I heard that tonight. So 1031 exchanges allows for deferral of any capital gains that you may have had on a real estate deal. I talk about this in Bigger Pockets. We talked about this on some of the deals that I've done, where 6 months, a year, 2 years, or more later, you have to establish long-term intent. So typically you want it to be a longer term, 2 years or more. There are ways to justify it to be sooner. You can sell the property, and typically it would be, if there was a gain, taxed at long-term capital gains. However, the IRS allows for what's called the Starker exchange or 1031 exchange, where as long as you identify a like-kind property, the gain on the sale of the property can be rolled into a new property and you don't pay any taxes. It's deferred into a later date. But going back to earlier's comments of stepped up basis, what if you were to defer indefinitely? It's my goal to own real estate throughout my life. I may sell properties, but I'm likely to use a 1031. If I don't use a 1031, it's probably because I have $5.2 million of depreciation. I can offset some of the sale and know I'm still not paying taxes, and allows me to take some money off the table. But otherwise, I'm in a 1031 exchange and continue to do so that I can defer my basis or my taxable event indefinitely. So there's also some cool things here, and I'm already out of time. I'll take 5 more minutes if you're okay with it, and we'll try to wrap up here. You could take a very low basis property, say a truck stop that you've gotten a massive benefit on, roll it to a single family home that you rent out for investment intent, 2, 3+ years, and later reclassify that home as a primary residence. And now if it's a primary residence, if you live in it 2+ years, you get the primary residence tax exclusion and an offset to that basis. Really, really cool strategy. This is a tax-free profit. You don't have to reinvest, so you don't need to use a 1031 exchange. You only have to have lived in the home 2 out of the last 5 years. So Carrie and I, when we were early on, we would buy real estate, live in it for 2 years, go and buy a new property with an owner-occupied loan because it's low down payment, rent it out, and within that 5-year time frame, we'd sell it. You could actually sell multiple properties, and as long as both of those properties were primaries at one time for at least 2 years or more, sell both of them and get both of them tax-free. You stagger it into different tax years, but you can do it over and over again. So I know a lot of builders who will actually go and build homes. They put $1 million into the home, but when it's done, it's worth $1.5 million. And then they live in it for 2 years, they sell it, and then they get $500,000 tax-free, and there's no need to do a 1031 because it all comes as tax-free. Really cool strategy. Primary residence tax exclusion, and it allows for an avoidance of depreciation. I ran out of time, and I wish I could have gone into more detail and some more use cases, but I want to leave you with this. This comes from Tom Wheelwright in part of his book. The government doesn't want you to pay taxes. The government wants you to invest in things that create jobs, that create wealth, and that create prosperity. And one of those things is real estate. Investing in real estate isn't just about building personal wealth. It's about providing solutions to societal needs by creating housing, revitalizing communities, and improving infrastructure. Investors help solve these problems that the government often cannot address alone. And the tax code rewards those contributions with incentives like depreciation and deductions, and I hope opportunity zone funds, because those will be awesome if they do come back. We will be exploring those if they do. If you want more content, more and more of what I do, I'm hoping to allocate my time to podcast. But we have a podcast, we have other socials. Feel free to follow us. We're happy to share more. And if you want to meet with anyone on our team, we'd be happy to meet with you. Thank you guys so much for coming tonight. I hope there was some nuggets that could be taken away. Appreciate everyone's comments. So thank you.
Man,
Yeah.
that was awesome.
Wow, that was so awesome.
What'd you think about it?
You know, every time I listen to Jason talk about this, I've heard him talk about it a few times, I pick something else up that I didn't really know before. It's like every time I get to hear him talk about all this stuff, the rep status, the retirement stuff, Roth IRA, you know, versus a traditional 401k.
Yeah.
There are so many little bits and pieces that are kind of simple, I guess.
Yeah.
When he talks about it in a way that makes it feel that simple. That's my biggest takeaway.
I always feel like Jason's playing chess. I'm playing checkers. I remember when I first met Jason, I was like, wow, that's awesome stuff. And then what's cool, one thing he always talks about is as well that I really like is he says, man, knowledge is not power. Applied knowledge is power. So all the stuff he just shared about really is pointless if you don't go use it. So I think that's the challenge is, can you take the things that he just shared and go use it?
I think that quote that he finished off with too, by Tom Wheelwright. Tom Welling. I think he played Superman in Smallville.
I remember that.
That was a long time ago.
Lana, yeah, I remember.
Yeah. Oh man, yeah. That was a good show. Anyway, yeah, Tom Wheelwright. That quote was pretty solid.
Yeah, I mean, it's being able to play the rules of the game just at a higher level, honestly. And really, so it's just like in sports. Like if you have a coach that really understands the rules of the game, there's certain things that and plays that you can call that help you win faster and more often.
Yeah, right.
Yeah, it's fun to listen to. Yeah.
Knowledge isn't power, but applied knowledge is power.
Yeah.
Applying that knowledge. So what's our next step?
Write down your question, and then I would say send it to us at contact at harrisinvestmentgroup.com. And then, yeah, we'd love to answer every question that people have. And I mean, we'll give you a call, honestly. I'd love to talk with you, answer any questions. We'd love to also invite people to our events that we throw. We throw a lot of events. Jason does a lot of speaking engagements. It's really fun to come in person, and he always opens it up for questions live. And so I would say, yeah, let us know if you'd like to come to that as well.
Yeah, we would love to have you. We have such a talented team here, from Jason Harris to Matt Denning, of course, Bronson Kaufusi, and a couple other Matts.
MattyP.
Lisa.
My team.
I'm on your team?
Yeah, my team.
Yeah, we can get you in touch with whoever you need to talk to. So any questions you have, you heard it, send us an email. And I think that about wraps it up. So hope you find your dad. I went to In-N-Out and he wasn't there. So,
all the burgers were gone. That's how I could tell. That's how
he wasn't there and the food was gone.
Yeah, so he was there, but he's just not there.
What's funny, when you said you're playing checkers and Jason's playing chess, I kind of feel the same way. I feel like Jason's playing chess, but always in our meetings, he'll always lean, when I sit by him, he'll lean over to me and he's like, MattyP, are you drawing pictures again? Because I'm such a visual guy.
Yeah,
right?
yeah.
Like my ADHD and my marketing background and the way my brain works. I'm not quite to checkers yet. I'm just in the corner coloring with my crayons.